Welcome to this explainer. Okay, today we're going to tackle a topic that, let's be honest, a lot of folks actively avoid. It's usually right up there with root canals and tax audits, but it is absolutely vital for your financial peace of mind. We're talking about life insurance, and specifically, we're answering the big question, how much do you actually need? Now, a lot of people just pull a number out of thin air or they rely on pure guesswork. But today, we're going to give you a super practical, no-pressure framework to calculate your exact needs. It's actually really simple, just your obligations minus your existing assets. No stress, just clear, structured steps. Let's dive into this.
To guide our explainer today, I want to share this really fantastic quote from Paul G. Wild, who's a professional in the insurance and retirement space. He says, educate before recommending. And that is the exact philosophy we're adopting right here. Paul emphasizes that the very first step in making any financial decision is just understanding your options in plain English. No unnecessary complexity, no exaggerated promises. So before anyone tells you what to buy, we're going to make sure you understand the why and the how.
All right, to make this super easy, here's our roadmap for the explainer. 1. Why buy life insurance? 2. Calculating your true need. 3. Term versus cash value. 4. The application reality check. And 5. Protecting your policy's future.
Let's jump right into part 1. Why buy life insurance? We really need to understand the core purpose of this coverage.
The core mechanism here is surprisingly simple. According to the National Association of Insurance Commissioners, or the NAIC for short, it literally all comes down to the death benefit. What is that? Well, it's just a payout made if you die while the policy is active, which you secure by paying your premiums beforehand. It's an exchange. You're trading a relatively small, known cost today for a large, guaranteed protection tomorrow. So, how is that benefit actually used in the real world? It goes way beyond just funeral expenses, though, those are certainly included. This money steps in to replace the sudden loss of your income. It pays off debts, it covers remaining medical or nursing care, it can even step in to fund childcare costs. I like to think of it as a financial shock absorber. It protects your family from experiencing a sudden, devastating financial hardship right on top of an emotional one. Okay, moving right along to part 2, calculating your true need. This is that simple framework for sizing your policy that we talked about. Before we do any math at all, the NAIC suggests you ask yourself this incredibly grounding question. Does anyone depend on me financially? It's a simple yes or no, but it really forces you to look at your immediate personal reality. If the answer is yes, well then someone's livelihood relies on your income, and we need to calculate exactly how to protect them. All right, here is that simple framework I promised you, no guesswork involved. Step 1, add up all your financial obligations. We're talking debts, income replacement, final expenses. Step 2, subtract your existing assets and coverage. That means things like employer insurance and your personal savings. Step 3, the result is your true life insurance need. It is literally just your obligations minus your assets. Let's put this into perspective. Think about your total financial footprint if you were to pass away. The mortgage, the kids' college funds, replacing your income for, say, 10 years. Add all that up. Now, compare that against what you already bring to the table, your savings, your existing investments. And listen, a massive trap people fall into is looking at their employer life insurance and thinking, oh, I'm totally covered. The NAIC warns that employer-provided coverage is usually way less than you actually need to cover all those obligations. Plus, if you leave that job, you usually can't take the coverage with you. So when you subtract your existing assets from your actual obligations, boom, you get the real gap that you need to fill. On to part 3, term versus cash value. Let's map out the insurance landscape impartially. So the highest level division in life insurance is term versus cash value. Term insurance is exactly what it sounds like. It provides lower cost coverage for a specific period of time, a term, like 10 or 20 years, but it generally doesn't build up any cash value that you can use. On the flip side, cash value insurance offers lifetime coverage. It can actually be more cost-effective if you know you need it for your entire life, and it builds up cash values inside the policy that you can access while you're still alive. Let's dig a little deeper here. If you're leaning toward term insurance, you absolutely need to know the difference between renewable and non-renewable term. This is critical. A renewable term policy can be continued at the end of your time frame, even if your health has completely gone downhill. Yes, your premiums are going to be higher, but you keep the coverage. A non-renewable term policy, when it ends, it ends. You have to apply for a brand new policy, and if your health has changed, you might not get approved at all. Now, what if you're looking at cash value policies? The two big players here are whole life and universal life. And the key difference isn't necessarily the coverage itself, but how you pay for it.
With whole life, you pay your premiums on a strict set schedule. It's highly structured. With universal life, you have a flexible premium payment pattern. That allows you to adjust things over time as long as you pay enough to keep the policy active. So it gives you a bit of breathing room if your budget changes. So you're probably wondering which one is right for me. Well, remember Paul Wild's philosophy from the beginning. There is no one-size-fits-all recommendation here. You have to weigh these options based on your personal life. Are you just trying to protect your family while your kids are young? Or are you focused on long-term legacy goals? What's your budget right now? Do you need access to cash later in life? Your age, your health, your income, they all dictate whether a term or cash value policy is the best tool for the job. All right, part 4, the application reality check. Let's look at what actually happens when you apply. Applying for life insurance isn't quite like clicking a button to open a new credit card, you know? It's a much more thorough process. As the NAIC points out, you start with basic info, name, job, that kind of thing, but then you're going to dive into some highly detailed health questions. Depending on the policy, you might even need a doctor visit or have a medical professional come right to your house to assess your health. And here is the most absolutely critical thing to remember. Absolute truthfulness is mandatory. The insurance company will verify your answers. If they find false statements later on, they can reduce or completely cancel your coverage. Honestly, honesty is your best policy here. Part of that application is choosing your beneficiary. This is the person or organization who actually gets the death benefit if you pass away. Now listen to this massive piece of expert advice. Do not name a minor child as a direct beneficiary. Why? Because insurance companies legally will not pay a minor directly. It creates this huge legal headache right when your family just needs things to be easy. Instead, experts strongly suggest setting up a trust or directing the funds to your estate to make sure your kids are cared for smoothly. Finally, part 5, protecting your policy's future. Let's talk about maintaining your coverage long-term. I want you to lock this number in your head. 10. Once you receive your brand new life insurance policy, you typically have a 10-day review period. Think of it as a free look window. If you sit down, read through your policy, and realize it just isn't what you expected, or you aren't happy with it, you can return it within those 10 days for a full refund. So when that policy arrives in the mail, don't just shove it in a drawer. Read it. And speaking of that drawer, life insurance is not a set it and forget it kind of deal. The NAIC strongly recommends reviewing your policy every few years. Why? Because life changes. If you have a kid, get married, get divorced, or get a new job, your financial obligations, remember all those things we tallied up earlier? They've likely shifted. You need to make sure your coverage is keeping up with your reality. Plus, updating your beneficiaries to reflect these life events costs you absolutely nothing. But forgetting to do it, that can cause chaos for your loved ones. So I want to leave you with this final provocative question. Think about that simple framework we learned today. Look at your current obligations, subtract your existing assets, and ask yourself right now, do your death benefits still meet your needs today? If the answer is no, or if you're just kind of sitting there thinking, I have no idea, well, you now have the exact tools and knowledge to figure it out. Thanks so much for joining me on this explainer, and go take control of your financial future.